Hey guys, what's happening and welcome back to our channel. Buying a new house is always a big deal. It's also a huge hurdle to overcome. There are a number of financial obstacles that have to be faced. The rise in the market prices never helps either. Let's look at why the first-time home buyers are in trouble. Number 8. Why is it harder for first-time home buyers? Landlords are more likely to vote conservative than property owners. However, they are pleased when property prices rise, making it more difficult for first-time home buyers to join the party. In 2020, not even the biggest slump in at least 100 years was able to temper the economy. House prices more than tripled in the 20 years after 2000, according to the Office for National Statistics, while income purely and simply expanded. Purchasing a home for the first time has never been more challenging. Even after the 1990s house price spike, an average first-time home buyer in the mid-2000s needed funds equal to about 30% of their per-year salary to cover the minimum home loan payment. Number 7. The FHA First-Time Home Buyer Loan. FHA First-Time Home Buyer Loans require a cheap upfront payout, moderate interest rate, reduced fees, and the option to postpone installments. The Federal Housing Administration and most jurisdictions offer these sources of financing on a nationwide basis. A first-time home buyer, according to the FHA, is someone who hasn't purchased a home in the previous 3 years. This includes single-parent families and displaced housewives who formerly only shared a home with a partner. Number 6. First-time home buyers pros. If you're just a first-time home buyer, the FHA First-Time Home Purchase Financing Program makes things a lot smoother. The central government and most jurisdictions also provide insured mortgage loans tailor-made to the first-time home buyers. These borrowings have appealing features that can make the home buying process less expensive and stringent. They aren't for everyone though. These loans are suitable for first-time home buyers since they have fewer restrictions. If you don't have enough funds accumulated for a significant upfront deposit, you might want to look into these mortgages. You have a limited capacity to pay hefty interest and fees because of your financial situation. Other loan kinds will not be available to you because your credit rating is insufficient. For a credit with a 3.5% down installment, the FHA protects creditors against possible loss and demands a qualifying credit rating of 580 or higher. However, most lenders would only authorize an FHA loan if you have a credit score of 620 or 640 or even higher. You must also submit thorough evidence of your income as well as meet the lender's repayment ratio, which is normally a limit of 41% to 43% of your total household income that goes toward monthly payments of all your ongoing and installment obligations. Number 5. First-time home buyer loans cons. FHA first-time homeowner programs have greater mortgage insurance obligations than traditional financing, which is a disadvantage. Unless you make a bigger closing cost, you must pay insurance coverage for the full duration of the loan. However, irrespective of your credit rating, FHA mortgage rates are similar to conventional loans, so you won't be stuck paying a higher than average mortgage interest rate. If you want to buy an extremely costly home in a wealthy neighborhood, you may have to seek elsewhere. The Federal Housing and Urban Development Department cut the national ceiling credit limit for most wealthy locations to $625,500 on January 1st. Loan limitations vary based on the area's typical earnings, so verify with your real estate professional or lending institution. Another disadvantage is the need that the home you purchase serve as your primary home. In other words, if you're looking to buy a home with the goal of trying to rent it out, you're unlikely to be approved for a loan. You may lose some financing advantages if you sell your property soon after buying it. With a first-time home buyer loan, you may not be able to pay it back at a later date or otherwise change the conditions of your indebtedness or security. While some of these loans may not require you to acquire private mortgage insurance, you may be obliged to use loan-provided insurance, which may have higher fees and longer payment terms than private insurance. Number 4. Real estate agent. Once you've found a home that you want, your realtor can compile a survey of comparable properties that have previously sold in the same area and assist you in determining the price you should offer. After that, he or she can create a risk-free purchase agreement and present it to the seller and the seller's real estate broker. Your representative can utilize his or her expertise and understanding to sell you and your offer during the pitch, boosting the chances of it being approved. If the seller counters, your agent can assist you in developing and implementing a winning negotiating strategy. After you've reached an agreement with the seller, your representative can assist you with the loan approval process, skillful home visits, and any price or terms renegotiation that may arise as a result of the inspections. As the deal develops, your agent can ensure that the seller is adhering to the contract's conditions and can assist with title searches, deposit, and settlement. You can successfully buy your first home without an agent if you had limitless time and patience, just as you can fix your own TV if you had limitless patience and perseverance. However, purchasing a home is likely to be one of the most difficult and essential decisions you will make in your life. There are numerous reasons to obtain as much expert assistance as possible, particularly if the assistance is required. Number 3. Finding the right home. Establish house hunt parameters once you've determined what you can purchase. Location, size, amenities, and price should all be considered. Remember that, especially in a quiet market, average prices are frequently higher than profit margin. Set your searching prices even higher than the amount you intend to spend. Make a list of every home on the market that fulfills your criteria with your real estate professional. Include properties that fulfill the majority of the standards, but not all of them. You don't want to miss out on something great just because they correspond precisely. Each of these residences should be viewed by you and your broker. Number 2. How much to offer. When you locate a property you like, ask your realtor for a comp assessment, which is a report of the size, features, and sale price of all similar homes that have previously been sold in the same area. Based on the questionnaire, choose how much to offer. Never make an offer based only on the asking price. If the asking price is very high, even a reduction of 5 or 10% may be inefficient. If the asking price has been decreased for a rapid sale, a reduction of 5 or 10% may disrespect the seller and put an end to discussions before they even begin. It's not about the asking price, it's about the worth. Number 1. Applying for credit before the sales agreement. You apply for a mortgage one day. You complete or finalize the loan and receive access to the house a few weeks later. It's crucial to pay attention to the time in between. You'd like to keep your credit as clean as possible. Getting a new credit or debit card, purchasing furniture or appliances on credit, or taking out an auto loan before the property closes is a bad idea. Your credit score and debt-to-income ratio, which is the proportion of your income that goes towards month-to-month loan repayments, are used by lenders to make mortgage decisions. Credit applications can lower your credit score by a few points. Your debt-to-income ratio will rise if you take out a new loan or increase your regular loan repayments. From the viewpoint of the mortgage lender, neither of these options is ideal. If you'd like to ask any questions regarding this, do let us know in the comments down below, and I'll catch you guys later in another video. Bye now!